Is it darkest before the dawn? If we look at the housing market right now, sales are down, new listings are down, prices are decelerating. So in the data, things make me the most bearish that they have all year. And yet, really good inflation data came in last week. The bond market rallied and mortgage rates took a notable dip below 7% for the first time in months. So maybe we're finally past the peak of mortgage rates? If so, how should we expect the housing market to react? We'll dive into these questions when we look at this week's numbers. Inventory dipped on the week, which included the long July 4th holiday weekend. Home prices and new listings dipped too. This is totally normal for a long holiday weekend. The market is slow, but doesn't appear to be grinding to a halt. Contrast this to the same week in 2022 when inventory rose by 3% in the holiday week. That was a notable change. Today is not that market. On the prices side, it is notable that last week had the first negative print year over year on the price of the new listing. So the newly listed homes for sale were priced 1% less than last year at this time. And I'll show more details on that below. And this Thursday, July 18th, we have our monthly webinar. So if you're not signed up for this one, I recommend you grab your spot now. This is a real pivotal moment in the data. The second half of the year is kicking off, and the story about which markets are leading up and down is shifting. So what about these new price signals? So I'll show you why and where this year's most common housing market assumptions may be changing now. There's a link in the description below to register for that webinar. Click that to save your spot. These are limited to 1,000 attendees. We get far more than that each month who want to join. So click that now. Save your spot for Thursday. And of course, at Altos Research, we track every home for sale in the country every week, all the pricing, all the supply and demand, all the sales, all the changes in that data so that you can understand it immediately as it happens. I'm Mike Simonsen. I'm the president of Altos Research, and let's take a look at the details of the U.S. real estate market as we're now in the second half of 2024. So there are currently 651,000 single-family homes unsold on the market across the country. That's actually just a fraction of a percent fewer than a week ago, fewer. And as I mentioned, the 4th of July holiday can do that, right? So inventory is 38.5% more than a year ago. Still 32% fewer homes on the market now than in 2019, unsold, sitting on the market. Inventory is growing in every state across the country. However, most of the U.S. still has fewer homes for sale now than pre-pandemic. So only a few places, Florida, Texas, Oklahoma, Arkansas, and Idaho have more homes on the market now than the pre-pandemic levels of 2019. The pattern to watch in the second half of the year is whether inventory keeps rising like it did late last year, or whether it plateaus like it normally would in the summer. So in this chart here, I've highlighted the last year, and there's a vertical bar for last year. You can see how inventory just kept running all the way through November last year. That was because mortgage rates rose from June through November last year to peak at 8% just after Thanksgiving. Rising rates creates more inventory. But look at 2022, which I've also highlighted here. In 2022, rising rates hit the first half of the year and rates had plateaued by July, and so did inventory. But then in September 22, rates jumped again unexpectedly, so inventory did a late year climb from September to November in 22. Finally, look back at 2019, which I've highlighted here. That's a more normal inventory time, and it would plateau in the July, August time and then start declining in late summer in the previous normal times. So that's what we're asking now. Is this it for inventory growth of that trend of the last 35 weeks? Is it done? Or will inventory run more from here? Mortgage rates dipped nicely this week with the great inflation news. Are we finally past the peak of those mortgage rates? If rates decline notably, maybe if they head below 6.75% to 6.5%, then I expect demand to pick up quicker than supply so that the inventory growth trend that we've been tracking for several months will reverse. We'll see flat inventory in July and August, maybe just like 0 to 1% moves in a given week. So keep your eyes here. Last week, of course, included the long holiday weekend, so the new listings are obviously down. Only 57,000 new listings unsold for single-family homes this week, with another 11,000 immediate sales. That's actually a very small number of those new listings that took offers and went into contract immediately. I like the immediate sales number as a gauge of organic levels of demand out there. The more people who are waiting and willing to buy the right place, they jump on a deal when they see it, then more immediate sales happen. Only 16% of the listings this week were immediate sales. That's super low and has been declining since early May. The 68,000 total new listings is actually 6% fewer sellers than last year at this time. So those numbers will rebound this coming week. You can see both red lines from the last couple of years in this chart of the new listings. Each line is a year here. You can also see that we're past the peak of new listings. Sellers peak at the end of June. So the question for the rest of the year here is, do the sellers stay ultra restricted like last year, or do they continue a little growth like we had in the first half of this year? So as we're seeing now, with 6% fewer sellers than a year ago in this 1 week, sellers are likely pulling back. And that will keep a lid on inventory growth for the rest of the year. No big surge of new listings is coming. But that also keeps a lid on total sales volume. You can't buy what's not for sale. So if we are past the peak of mortgage rates and demand picks up, the total number of new listings each week probably won't pick up much, but the percentage that are immediately sold will. So 16% of these new listings were immediately sold this week. If we do see demand improve in the second half of the year, one place to see it will be watching the immediate sales climb back to maybe 20% or more. The sales are down for the holiday week too, of course. 58,000 new contracts this week. It's just about the same level as the last 2 years over the holiday. And here's what's interesting about the sales rate. It was measured by the weekly new pendings in this view. In 2022, you can see a dramatic drop off in the new pendings volume after the end of June. That's the light red line here. The sales rate hasn't recovered for 24 months now. So you can see further declines later in 22 when rates jumped unexpectedly in September of that year. So there are 382,000 total single-family homes in contract. That's unchanged from last week and just 1% more than last year. So not really seeing any sales growth. What I'm looking for in the pendings data, if rates fall in, for example, July and August, then we should see the new pendings tick up from 65,000 a week to maybe 70,000 a week. So that would be a slight lift in sales, maybe 8%. And if mortgage rates dip below 6 3/4 or so and stay there, that's one place we could see the shift. In this chart, the light red line is from late 2022, right when the market slowed dramatically after the 4th of July. The red line, the brighter red line, is last year when it was super slow all year long. This year started out with some momentum, but that's been pretty much lost. And if money gets cheaper, then it'll be interesting to see how quickly these sales numbers show it. I should point out that we are seeing an increase in the withdrawals rate now. We can track the homes that were listed and then they were pulled and they're not in contract. So these are discouraged sellers who don't have to sell. So that's keeping a lid on inventory growth as well. The median price of the new listings this week is $450,000. That's down 1% from last week and unchanged from a year ago, flat from a year ago. The median price of the new listings, the cohort of newly listed properties this week, is $404,900. That's a big drop for the week, and again, it's the holiday. And by this measure, tracking all the new listings in a given week, these prices came in below the same week a year ago, 1% cheaper than a year ago. And as I mentioned, this is the first negative print for the new listings prices in over a year. So now this is 1 week. It's a holiday week. Prices will jump next week. Like all of those caveats, keep in mind. There's always some noise in this measure of the price of new listings. That all being said, it's notable that the noise didn't push the other direction. The price of new listings has been running about 3% more than a year ago. So 3% home price appreciation measured by those. That's compressing as the year goes on and demand wanes with these higher mortgage rates, right? So having one negative print is part of that compression. The median price of the newly pending contracts, that's what we're watching here across the country, that's down 1.5% for the week. Prices always notch down over the holidays. But these pending contracts are a proxy for what's selling. So these homes are not yet sold, they're in contract, but they're the ones that started the sales process this week. So these prices are also running about 3% more expensive than a year ago. So just like on the listing side though, this spread is compressing. So it was 4 to 5% year over year gains, now it's 3% year over year gains. So in the coming months, home prices will generally decline as we pass the peak of the buying season. And we're going to watch for that spread over last year to compress too. I've said a lot in recent weeks. I expect that compression to continue. So we end the year in the 0 to 3% range. If we're past the peak in mortgage rates and demand picks up, it's not clear to me how quickly we'll see the spread increase again, that growth in home prices, but we're going to watch for it because that is a potential outcome. And then one of the reasons I continue to expect home price appreciation to decelerate is this price reductions leading indicator. 38.3% of the nation's listings have taken a cut from their original list price. As you can see in this chart, that's more cuts than in any recent July. The curve here seems like it's slowing a bit as the summer grows later. There's only a 30 basis point increase in this metric for the week. Again, so much of the nuance moves in this data reflect consumers reacting to changes in mortgage rates. If we get lucky and mortgage rates ease from here for the rest of the year, for example, then one place we'll measure the rebound in demand will be in fewer price cuts. When you list your home, if you don't get the offers, you cut the price. When a few more offers are made by newly affordable mortgages for buyers, right, then this stat plateaus and may even tick down. So in the last two Septembers, 22 and 23, we saw big jumps in mortgage rates that made home buyers back off, and we could see jumps in price reductions at the same time. So each of the last 2 years had sharply rising rates at the end of the year and subsequent boosts in price cuts. Those two jumps in cuts happened pretty much to the day of the mortgage rate spikes, very closely aligned. So that's what we're watching here too. And that's why we do this data work each week. Mortgage rates stayed higher for longer than anyone anticipated this year. And it's not clear that they have turned the corner, but maybe, if we're lucky, for your buyers and sellers, these conditions can change quickly. They need to hear the data from you. So you should join us at Altos. Go to altosresearch.com, book a free consult with our team. We'll help you know how to talk about the market with your clients, your prospects today. There's a link in the description below to join us. Click that and let's get started.